Hello and welcome to the Gold, Goats, and Guns podcast for June 22nd, 2023. My name is Tom Luongo, and we have a lot to talk about. It is episode 147. I have the great pleasure of getting to meet David Hay today. He's the publisher of the Haymaker, author of Bubble 3.0, the book Bubble 3.0, as well as the Co-CIO of Evergreen Gavekel. David, having watched his stuff in the past, and just watched his last appearance on Palisades Gold Radio with my good friend Tom Bodrovics, and it was a fascinating conversation about where we were back in March, and it was going to be fun to update what David has to say about things since then, because since he was on, Silicon Valley Bank blew up, so did First Republic Bank, and from my perspective, the open warfare between the San Francisco Fed and Jerome Powell's New York Fed is pretty much obvious, especially after Jerome Powell's testimony this morning before Congress. So, David, welcome to the show. Let's do the thing and get to know each other. How are you?
Thank you, Tom. Doing well for an old guy.
Oh, yeah, same here. Like I look in the mirror, and every day all I can think of is something that someone said to me when you became a father, that the days are long, but the years are short. And I don't know. She's going to graduate.
You could be my son, Tom.
My God, I'm 55 now. So, all right, let's.
I'm almost 68, so I got you. Okay, younger. You're my younger brother.
Yeah, I became an uncle. It's at 13, actually. To be honest with you, that's how old my family is. I'm the youngest of four out of from a father who was 40, and the youngest of 11 of an immigrant family from New York. So, David, when you were talking with Tom back in March, it was fascinating to listen to what you were talking about then, and how things have played out almost eerily the way one would have expected, other than there being all the turmoil with the regional banks over in San Francisco. And we're on that verge, I think. Now, you were talking about the problems that were incipient in commercial real estate. There were problems with credit spreads that you were worried about then, and how that was going to affect the stock market, and what Powell was going to do, and how the Fed was going to have to react to this. What are you seeing now? Right? Are we still on track for, in your mind, a recession sometime in the second half of this year? And to my listeners, I focus on commodities and obviously gold, but also geopolitics and all of that stuff as well. So I don't know. I'm just going to throw it out there broadly. I just want you to paint the picture in the background, and then we'll just take the conversation from there.
Well, obviously it's all good because we got a raging stock market. Just unbelievable move by the Nasdaq. So it's you also have seen here recently something different than what was the case through the end of May, which is a broadening out of the market. So some of these more cyclical, whether it's small cap or some of the industrial names, a number of industrial stocks making new highs. But you mentioned commodities, and if you look at the commodity complex, it's acting like it's going to be a deep recession. Energy, oil in particular, just keeps getting beaten like a redheaded stepchild. So it's a very, very strange situation. You would think with these big bank failures and some of the other macro headwinds that are intensifying, that stocks would be much more guarded. And you think credit spreads would be widening out. And that's been another surprise to me, is that credit spreads have actually narrowed. Now they're not super tight, but they're not at any kind of alarming level.
No, we're talking about the spread between, sorry, just to interrupt, just make sure that you understand that it's, because I talk about sovereign bond spreads between Europe and Japan and the US, but for this audience, I think you mean the difference between government debt, US treasuries, and corporate debt. Is that correct? Exactly.
So the spread is the yield differential between the two. Thank you for clarifying that, because it is such an important point. And I don't want to assume people know what it is. But if you look at 2020 as one example, when we had the COVID crash and the pandemic panic, and we had credit spreads absolutely erupt, which is kind of a normal reaction to a crisis. So that differential blows out, and it is a hugely negative thing when that happens. I mean, that's what also happened in 2008, 2009 during the financial crisis, and the Fed at that point did nothing. It let credit spreads widen out to the widest they had been since the early 1930s during the worst of the Great Depression. And that's how bad it was in the bond market back in 2008, 2009. High yield bonds went to over 20% yields, just to make it really a graphic point. Then in March of 2020, when COVID was going viral, literally the Fed realized they don't want to make the same mistake. So they actually bought corporate bonds, or announced that they would buy corporate bonds. In reality, at the end of the year, they bought only like 18 billion, rounding error compared to the trillions and trillions of QEs they did over the years. But it was enough. Just the announcement that they were going to buy corporate bonds was enough. I mean, if you go back to that day, that's when the market bottomed. That's when the stock and bond market both bottomed. Things took off, even though economically it was getting worse and worse and worse. My point is, it just shows you the power of credit spreads. So right now, credit spreads are very well behaved, and that's odd because you're now starting to see corporate defaults go up at the fastest rate since 2008, according to Jim Grant, who's about as good as there is. You've got the SLUs, the senior loan officer surveys, going to recession levels. So the banks are basically panicking, and they're losing deposits like crazy. And so it's an very odd situation in so many ways. And I guess I'm kind of thinking about the analogy to this, that because a lot of people believe, Jim Cramer, who I usually disagree with, which I think is a good thing, frankly, given his track record, and he declared a couple of weeks ago, soft landing or no landing. And yet you've got Stan Druckenmiller, who's out there, one of the most brilliant investors of all time, saying he thinks a recession's underway right now. He thinks it's the most unsustainable fiscal situation he's ever seen for America, which I totally agree with. We can talk about that later. But the analogy I was going to use is that for those people that think, geez, these people have been worried about a recession for a year, it hasn't happened, therefore it won't happen. So my silly little analogy is, imagine a very successful football team that starts to have a few injuries, and yet they keep winning. Just like the U.S. economy is very successful, and it's continuing to look pretty good. Not great, but pretty good. But if you continue to get key injuries, at some point, you will start to lose. But yet people say, well, we've heard that, and they're still winning, so don't worry about it. But at some point, this stuff just accumulates, whether it's the straw that broke the camel's back, or that, last grain of sand that brings down the sandcastle, whatever it is, or the snowflake that causes the avalanche. And I think it's naive to think that with a yield curve this inverted and inverted this long, with leading indicators that are down for 13 straight months, that we're not going to have a recession. Another one that very few people look at that I think is quite interesting is GDP plus. So that's a combination of GDP plus gross domestic income, GDI. And it's had a flawless indicator or flawless track record of predicting recessions. And it is saying we are going to have a recession. It's interesting, if you look back, remember a year ago, we had 2 negative quarters of GDP growth. Right. Well, GDI did not go negative. It did not confirm that. So once again, a good signal. It's nice to have both of those, but right now it's a very different situation. So I'm convinced we're going to get a recession. Maybe it started already, but I think somewhere in the third and fourth quarter, it's going to be very hard to avoid. And I think that the complacency, you can see it with the VIX on the stock market being extremely low right now, that could lead to a really nasty surprise for all the people that assume that the recession is not going to happen.
Okay, so and for the most part, I agree with you. Like at the beginning of the year, I said, we're going to be in a recession, but it's not going to print as a recession until we get to 2024, just because of the overhang and spending and variety that's been going through, and a variety of it'll feel like a recession, it'll look like a recession, but it won't be called a recession until we actually get into because all we have to do is get into positive GDP into the third quarter, right? And there can be no recession in 2023. Like it can be announced in 2024, right? Because we're going to have all of those things plus the 2 straight quarters of negative GDP growth, and there's too much spending on the horizon. And this is part of the Stan Druckenmiller's point that the fiscal situation is out of control. But the interesting part about this, and I think that maybe some of the extremity in the data comes from this. We had Janet Yellen for 8 months, from like the day after the Republicans were announced to have won back the House, that she was screaming that there was going to be this awful debt ceiling fight, that there was going to be a default and everything else. And this is, again, one of those management perspectives. If you talk about, the ability of the Fed to jawbone the market and get credit spreads to stop widening. Well, Yellen was out there for months jawboning that everything was going to go to hell in a handbasket, right? And this went on and on and on and on and on until they finally just, locked the doors on a Tuesday and came back on Wednesday and go, oh, no, we have a deal. And it's not even a good deal. It's a terrible deal. It's a deal that more Democrats like than Republicans. But to me, since then, you can see it like I've seen it in internal spreads within the U.S. yield curve, right? That we're starting to see a positive structure to the yield curve all the way out to a year now, or 6 months in the year, and those spreads are, and those inversions are now moving out the yield curve, right? So the 2 month, 3 month inversion or spread, the 3-6, the 6 month, 1 year, the 2 year, 3 year. This is the way I've kind of been starting to look at it, and it's, you can start to see it's all that inversion is starting to move out. Like there's all of a sudden there's not as much fear in the marketplace, and so there's now liquidity that was, or money that was sitting on the sidelines going, I don't know, is the U.S. going to default? What are they going to do? And now they kind of did it, right? And they've kicked the can down the road till 2025. So maybe that's going to be enough to have things limp along well enough, and for foreign capital to begin popping into the market and into the United States over the course of this quarter and into Q3. What do you think about that?
Well, yeah, there's a lot there. I guess I would say that one of the most direct impacts that we're seeing right now is the TGA, the Treasury General Account,
Right.
Janet Yellen's checking account, which got drawn down to a very low level during the debt ceiling, drama. And that's now being reliquefied, which is actually a negative for financial markets and the economy, because that's draining liquidity. So that, you could say that one of the drivers of that second quarter rally in the stock market was because the TGA was being drawn down. So that's money coming into the system that's just kind of free money. There's really no cost to that money coming in when it's coming out of the TGA. So now it's going the other way. In fact, I saw that in that time period was about a 3% tailwind, benefit to GDP, and now it's flipping into about a 10% headwind because it's going the other way. And the other thing that is, and we touched on this a little bit, why I think that we could have this 4F scenario, which is a federal fiscal funding fiasco, and in the second half, because the amount of money that needs to be raised, that's one aspect, and the deferral of the Treasury issuance, not just the TGA, but the Treasury, Treasury bonds weren't being issued there for a while. So, you've got somewhere close to $1 trillion of kind of accumulated financing that needs to occur. And then you've got the government deficit, which is absolutely exploding. Most people don't seem to be aware of that. We were at $1 trillion deficit, which is bad enough. We're basically going to be at a $2 trillion deficit for this year. So in the second half of the year, you've got another $1 trillion needs to be financed. You've got the Fed and QT. So they're liquidating at roughly $1 trillion annual rate. Now they backed off. They reversed that during the banking crisis, but everybody seems to believe the banking crisis is over. I don't. I think we're going to have another round of it, but more than what I believe. Chris Whalen, who's probably the best, he's the one that early in the year when everybody was still saying, hey, higher interest rates are good for banks, he said, up to a point, but you better be careful, because at this juncture, almost every bank in America, if you mark their loan book and their investment book to market, is broke. Even right. JP Morgan. Now that's not going to happen. They don't have to do that. They went through that kind of process in 08, 09 until they changed the rules, and that was a disaster. But the reality is, the first part of this banking fiasco has been because of their safest investments, government securities. That's what brought down Silicon Valley Bank. That's what brought down Signature Bank and First Republic. They got clobbered because of duration risk. Basically, interest rates went up, and they took these huge hits on their government bond portfolios. We didn't think that could happen, but it did happen. The depositors got nervous, and so they had to sell. Anyway, but what could create round two would be problems in the loan book,
right?
Because a lot of loans are starting to struggle. You mentioned earlier commercial real estate. That's definitely a problem area, especially office, which is a disaster. We're seeing trophy properties in some cities changing hands at 20 to 30 cents on the dollar. So that's an issue. Now, you were talking about foreign money coming in, and my esteemed partner Louis Gov, who's the Gov and Gavekel, believes that we're going to see these foreign entities, whether they're central banks or sovereign wealth funds, invest in U.S. equities. He thinks that's what's been happening. Mm-hmm. They don't trust the bond market, and they're not at all thrilled with yields and 3.7 or 8 on a 10-year Treasury.
Right. So
they're going into the hot areas of the stock market. I don't think they're a whole lot more prudent or rational in their approach than the typical retail investor, who is also charging into basically large cap tech. And of course, AI's provided the narrative horsepower to that move.
Agreed.
So Lots of cross currents. I think it's one of the most confusing times I've ever seen. I've been in this business for 44 years, and I've never seen as much. I mean, you can pretty much grab whatever set of data you want and say, okay, we are going to have a recession, or we're not going to have a recession. We're going to have a market crash, or we're going to have a continuing stock market, recovery. And so
I agree with it.
It's
Yeah.
very tough.
No, it is. It is very, very. It is a very, very interesting time, and I happen to agree with Louis Gave about this. That I do think that what the markets are craving at this point is some kind of stability from the United States. That they want some kind of stability, be it political stability or legal stability or something. And it just seems like every day, foreign policy stability. And it just seems like every day the Biden administration goes out of their way to vandalize our reputation as a country around the world. Like we're going to have Victoria Nuland and Jake Sullivan go over to the Netherlands and dress down the rest of the world for not for doing business with the Russians, for example, and trying to create create World War III. Well, that's a huge tail risk for the markets. From my perspective, I like to do the intersection of big geopolitical stuff with the way the markets react to that. And so I see things like to Blinken going to meet with Xi Jinping. I see the NATO summit 2.5 weeks from now in July 11th. And I just say to myself, there's something going on there. And so, for example, Powell's on the Hill this morning. We're doing this on June 22nd. And I'm looking at the markets this morning, right? And the dollar is down. The dollar index is down. Gold is getting beat. Oil's down $2.50. The euro is up and bonds are up. And bonds are being sold. So it's like a sell everything day, except the money's and even so, this is one of those weird days where Powell's on the Hill saying one thing. You would think that, in a situation like this, why is everybody, where are they going? Where's the money going? Because the stocks are down a little bit, everything is down. But the only thing I think is even the Nikkei, which is blown out to new all-time highs, is even off today. So, and it's happening in response to what Powell's saying on the Hill, which is that, look, I'm not going to back off tightening. So I this is one of those things like, where is capital going to slosh to next? Or is it just kind of all going to ground, waiting for the next shoe to drop? So.
Well, I think it's very easy for money to move into short-term treasuries right now, or money funds, which basically the money funds take that and they go to the Fed, and the Fed's paying them over 5%. So but I think that's a very important point. I did talk about this with the other Tom back in March, is that I think what's kind of underappreciated, or not even appreciated at all, about what's happening is that there is this mass. You had about $1 trillion, put a hard number on it, that's moved from bank deposits into U.S. Treasuries or government money funds. So what that means is that when it's in the banking system, it's high octane money. When it goes into government securities, it's low octane money. And that transition is continuing. There's still something like $15 trillion of bank deposits out there, which are earning very low rates. Now, the banks are starting to grudgingly raise those rates to try to prevent the deposit flight. But they're so far behind where where Treasury rates are, that process is going to continue. And so what that means is that you've got a falling velocity of money.
Yep.
And money velocity is very, very important. The old famous formula is the money supply, which is also falling, times velocity equals basically economic activity, or nominal GDP. So if both velocity and the money supply are falling simultaneously, as they are, that's really a major headwind. And who talks about that? I mean, Mike Wilson from Morgan Stanley, who's great, and he's taking a lot of heat right now because he's been worried about things. But that's just, I think the biggest thing that's going on right now is the lag effect. And Powell does talk about this occasionally, that monetary policy changes work with long and variable lags. And so there is this tendency to say, hey, look, they've been tightening, and yeah, the money supply has been falling, but there's still a lot of money in the system from before. And therefore, it's kind of what I was saying earlier, everything else you guys have worried about hasn't played out. Right. So it's not going to play out. Yet I would argue that the more these things accumulate, more these drags accumulate, the more likely eventually you're going to have that Wile E. Coyote moment where you go off the cliff. And what's probably going to trigger that will be, steep rise in unemployment. Because so far the jobs market has stayed, relatively resilient, but there are a lot of warning flags on the jobs market right now. And for example, and your guest that you're going to talk to later today is going to talk, how many states are seeing rising initial claims for unemployment. It's about 80% of the states right now.
Mm-hmm.
You're seeing drastic fall offs in revenues in a number of these, particularly northern states,
Mm-hmm.
and deficits are exploding. So, and the same thing with the U.S. government. It was about a 20% drop off in revenues. About a 10% drop off in revenues, about a 10% increase in expenditures. So that's one reason why the government deficit is going from $1 trillion to $2 trillion.
Right.
So again, there's plenty of straws in the wind, but you can also say some of the data still looks pretty good.
So to this point, and this is one of the things that I try to do not just the macro, but the global macro picture, which is to say, okay, well, the world still needs dollars, and because it still liquefies 88 to 90% of world trade, and blah 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 blah. It's still 59% of foreign central bank reserves, and all the corporate debt, all the dollar denominated corporate debt that's out there, yada yada yada. Because of the decade of QE at the zero bound and all of this. Now the question is, you've done a wonderful job, and most analysts, including, and I'm going to invoke Daniel Booth in a second here, have done a wonderful job of explaining what's going on domestically. But the thing is that the U.S. markets don't operate in a vacuum, clearly, because we're the global reserve currency. So then the question, and this is the question I keep asking, and it's not just, I'm not asking you directly, I'm just asking in general, which is, as bad as things are maybe here, which no one's denying, I'm not denying that they're not moving in that direction or even there, but how bad is everybody else who's dependent upon dollar flow, right, in order to keep their economies from collapsing? And so then the question is, if they're in worse shape than we are, then investors there are going to naturally try and find a relative safe haven. And one of the things that I've been thinking about is one of the things you do when you want to attract capital is obviously you raise interest rates. So the way I see this in the grand scheme of things is that Powell is trying to redomesticate the dollar in many ways, that the beginnings of the age of the end of the world of the global reserve currency is beginning. And this is why the data is so confusing. It's not that it's going to be gone tomorrow or anything like that. It's going to take 10, 20 years for this to happen. But we're at that transition period, in the transition period from one monetary policy to another, from the Fed being the global central bank to the Fed being a domestic central bank, or at least domestically focused central bank. And we have to take the hit, and we have to deal with the recession, because the recession is clearing out all of the dross from the ridiculous boom of the ZERP and QE years. And I think that's the way from a broad perspective, that's kind of the way I look at this. And if you listen to Powell talk, it's almost like he's saying that, and that we're just going to have to take the hit to make the play, and to put it in hockey terms. So.
Well, I certainly agree with that part, that we have a different Jay Powell than we had back in 2018, where he caved very quickly. He went from telling everybody how great it was in October, and then by the end of December, he did a complete 180, and then was, cutting interest rates later in 2019, and he stopped QT at that time, quantitative tightening, and went back into QE with a relatively minor market hiccup. I mean, the market briefly was down 20%, and I think intraday and at the end of 2018, before it then had a massive rally on his pivot at that point. And if he was going to do that, he would have done that last year, because last year was far worse, because not only did people lose money on stocks, they got clobbered on bonds. So it was the worst year for balanced portfolios since 1871, and yet he kept tightening. I mean, what you hear, and I think this is true, is that he's very focused. Now that he's been reappointed, he's very focused on his legacy. And he wants to be seen as the second coming of Paul Volcker, and not Arthur Burns, who was the much derided Fed chairman during the 1970s.
Yes.
But I think actually Powell was worse than Burns, at least until he started to really get religion on fighting inflation, because he was still printing money in the spring of last year, even though inflation was roaring through 2021. And of course, he kept saying inflation is transitory, but he's in a completely different place now. I think the market's underestimating this. I mean, they keep thinking that he's going to start cutting, and he's saying, no, I'm not going to cut. If anything, I'm going higher. So
Okay,
it's
so my argument about this, and this is something that I brought up, and I don't know if you've heard this from me, but I thought Powell started tightening global dollar supply back in June of 2021 when he started building the reverse repo facility by raising the RRP rate 5 basis points over the Fed funds rate, which then pushed $2 trillion into that facility, sopping up over $1 trillion worth of the COVID relief fund. So the CARES Act money that the Treasury had raised all this money and then they spent it all, and he sterilized a lot of it by doing that. But that's what actually broke a lot of the foreign currency bull markets. It broke the bull market in the euro. The euro dropped from $1.22 to $1.19 like in 2 days, and then has never recovered since then. And it's just been a slow degradation since then. And it was very clear to me at the time, and I think even Danielle mentioned this, in her way, that Powell was in a political fight for his life, that in order to get reappointed, he had to go along with the prevailing political narrative, which is that we were in a hangover, COVID was still in place, remember Build Back Better and all of that. And that the day he was finally allowed to be reconfirmed, and then actually everything about the Fed changed the day the FOMC elected him chairman pro tem, not even his reappointment. That's what actually set up his reappointment. Once they said, look, we're not getting rid of him. You can't put you can't put anybody else in place. That's when the real Jay Powell stood up. And I want to bring up one other thing, and this is just another. Well, I'll leave it there, and then I got something else I want to throw at you after that. So, give me your commentary on that. Do you think that's? Do you see?
Yes, I think that's right. I think that's. First of all, I don't think he's going to run for re-election. I mean, he's not a kid anymore, and
right.
I think this is it. I think this is, because he doesn't have to worry about running for re-election. And in fact, he's going to do what he thinks is in the best long-term interest of the Fed and the country, which is to get inflation down. He's on a mission to get inflation as close to 2% as he possibly can. I think it's going to be a very tough thing to do without a significant rise in unemployment. And so. But I think he's willing to take that. I think it gets back to the Volcker thing. Volcker took a wicked recession in the early 80s to break the back of inflation. And I think Powell's willing to do that.
And now, I think, one other side on this is that I also really do believe that this is not just breaking the back of inflation, because he said the other day, like, core inflation is not responding to interest rates. Non-core is the only thing that's come down, meaning gasoline prices, right? So energy prices have come down.
Lumber
prices have come down, right? All of that stuff has come down. We've had an epic commodity boom and bust, 300% up, 250% down, or 200% down, right? Or 75% down. So we're now at levels on all commodities that are what used to be the price ceilings are now the price floors. So around $4 a pound for copper, $3.75, $4 a pound for copper, blah, 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 all the way across the board. Aluminum at $1 a pound, yada, yada, yada. So $7 a bushel wheat, for example. I've always looked at this as this has been the Fed's silent war against the excessive leverage in the offshore dollar markets, which have hampered his ability as Fed chairman to actually prosecute domestic monetary policy, because the shadow banking system, as we know, dwarfs the domestic banking system. And that's what needs to be shrunk. And the price that we have to pay is a recession here, and the re-onshoring of global capital, that for 50 years we sent dollars out and got goods in return, and now we're going to bring dollars back, and we have to rebuild the industrial base of America. And this has been my argument, that this is why he's really doing it, and inflation is just a cover story. I mean, he needs to get inflation down in order to present that positive return of capital, right, in real positive interest rates on U.S. debt. But at the same time, it's what he's doing is bringing those dollars home, because they're clearly being repudiated overseas thanks to policy on Capitol Hill. The political policy and the foreign policy on Capitol Hill is making the dollar expensive more expensive for everybody to use, and so those dollars need to be sopped up without causing hyperinflation here at home.
Well, I think this has been going on for 50 plus years, as far as the U.S. running pretty chronic trade deficits, which means we've been shipping, trillions of dollars overseas over that period of time. And what's happened to that money has largely been a recycling process. whether it was the petrodollars of the 1970s or the, Japanese, huge trade surpluses of the 1980s and then China's in the 1990s and early 2000s. How did most of that money come back? It came back in the form of U.S. treasuries, right?
Mm-hmm.
They bought treasuries.
Right.
More recently, they bought a lot of stocks.
Mm-hmm.
I mean, the Swiss National Bank is one of the largest shareholders of U.S. Companies, and they did it with their magical money machine, their printing press.
Right.
Another story, but the money has largely come back to the U.S. and most of it through the bond market. But what's been happening, over the last 6 or 7 years in particular, is divestment by these big foreign central banks of U.S. treasuries, and that's a big deal. And it gets back to what I was talking about earlier with this 4F scenario where all this money needs to be raised in the second half of the year. We used to be able to rely on these foreign central banks and sovereign wealth funds, but there's kind of a buyer strike going on right now. I mean, they're actually, as I said, they're selling, whether it's China or Japan, their treasury balances are down.
Yeah.
And yet we need them more than ever now to finance this tremendous trade deficit. So that's what I worry about, is that normal kind of recycling process is not happening.
Agreed.
At a time when it's critically needed. So to me, that's the big risk. But also when I was listening to what you were saying, I think what you're describing is a deleveraging process.
Mm-hmm.
And you mentioned, you're very correct, the shadow banking system is ginormous, to use a very technical term. And it is, it's not regulated. You've got some very smart players in there, but I think you got a lot of dumb players too. And I think they've made a lot of ill-advised loans. And gets into this whole thing about long and variable lags, that as these interest rates go up, a lot of these companies that were getting shadow banking financing were at variable interest rates. And, if you're holding that debt, you go, oh, great, I'm getting a higher rate now. I'm getting double the rate that I was a year ago. But the question is, can those companies afford it? And I think the answer to it in many cases is they can't.
Right.
They're going to go broke. And that's why, why are bankruptcies all of a sudden, soaring? Mm-hmm. So it's to me a very fragile situation. Absolutely. And when I see the VIX down to 13 or 14, the S&P trading at 19 times forward earnings, it's like, okay, are we really factoring that? Another thing that's fascinating to look at, a couple things. One is the equity risk premium. So you look at what is the earnings yield, if you will, on the stock market. So let's just say that the PE is 20 to make the math really easy. That means the earnings yield is about 5%. 20 into 100 is 5%. Right. 19, which is the actual PE, is a little bit higher than that. But that's where short-term treasury bills are. So you're really getting paid virtually nothing to take the risk of owning stocks. That's very unusual.
Yes.
It's almost unprecedented. Then let's think about the earnings themselves. I mean, the reality is profit margins are, even though they've come down somewhat, they're still way above normal. And a lot of it's being done with smoke and mirrors, frankly. There's a lot of accounting hijinks that are going on, even with companies like Google, mm-hmm. Which are extending the life of their servers. They're just declaring, instead of 4 years, they're 6 years. And that's something like $800 million. It's a huge benefit to their earnings just with that kind of accounting sleight of hand. It's typical, you see this at the end of up cycles. Companies get desperate to keep their earnings up, so they start playing all these games. So Mike Wilson has said, again, he's the chief strategist at Morgan Stanley, I think one of the brightest guys on the street. Mm-hmm. And he said that earnings quality is the lowest it's been in 25 years. So not only is the equity risk premium low, but the earnings are exaggerated, which would make that higher yet if it was, lower yet if that was properly adjusted for. So there's always pros and cons. Right. But I just look at how many cons there are out there right now, and it's almost like the big house. It's just, there's a lot of cons, and which ones are going to dominate? Which one's going to be the trigger that really causes things to change? And in my mind, the most likely is that we have, a real train wreck in the treasury market at some point here in the next 6 months. And it won't be at the short end because there's enormous demand for short-term treasuries, but at the intermediate to long-term, right. I think that's where you could have a real problem. Now, maybe I'm dead wrong about that, but when I listen to somebody like Stan Druckenmiller or Ray Dalio, mm-hmm. Dalio makes a critical point. He said that at some point, whether they're international or domestic investors in treasuries, they're going to wake up and realize the only way they can get repaid is with printing press money. So there's really only two ways when a country is as over indebted as the United States is right now to get out of it. One is through defaults or, some kind of restructuring where people get, 50 cents on the dollar for their bonds, or through inflation. And essentially the world's reserve currency still. And I don't see that changing. I think it's eroding around the edges, but sure. It's not going to go away overnight. So what the Fed's going to do, what it's going to be forced to do, and this could actually trigger Jay Powell's resignation, is it will have to restart QE. And I think he will hate to do that.
I don't think I think I'll be honest with you. And this is one of the when I was listening to you talk with Tom earlier today, and that was the area I'm like, I don't know that I see that, and it's because I expect actually to see the end of QE in Japan, and the Bank of Japan having to allow it to go, which is going to actually restructure Europe, Japan, and everybody else, and the money's going to flow, and that money is going to flow here. That's what I see. With the Resolute.
So what you're saying is the end of so what the Bank of Japan is doing right now is yield curve control overtly.
Right.
They're suppressing their 10-year government bond.
They're not right now because the 10-year government bond is trading below the threshold. Remember, Kuroda moved it back to 0.5% in December in order to defend the yen. When the yen hit 150, now the yen's back at 142, 143. And since the Silicon Valley Bank failure, the 10-year has been trading below the threshold. So there's been a whole lot of short yen covering that's been going on. It's still going on. It's been going on for 4 months now. And but there's going to come a point when we start getting back up towards 150 on the yen, and Ueda is going to have to do something about this. And I think that part of this is allowing Christine Lagarde, because who, by the way, the entire, to your point earlier about treasuries, China and Japan have been selling. There's no argument about that. The numbers are stark on the TIC report. But if you break it down, which I've done by region, the Eurozone, that would be around the Euroclear, all of the, like the Caymans and everything you would consider around the European shadow banking system. It's all been rising. They've been buying a lot of U.S. treasuries. They've been soaking that up in order to defend credit spreads in Europe versus U.S. credit spreads.
I'm not sure how much of that's actual government entities behind that, because supposedly, and I think it's Luxembourg, it's one of those entities, but you mentioned the Cayman, that's another one where that's where the hedge funds operate. So if
Euroclear is in Belgium.
What I've seen is it's basically hedge fund buying. They're buying a lot of treasuries. They want those high yields too. So I'm not sure that's really governments, European governments investing in American treasuries.
What I'm saying is it's actually the ECB doing it. I'm that the ECB is the only player really in the European bond market, and Lagarde has to manage credit spreads. Remember, she put the TPI in place last July when Powell raised the last time for 75 basis points, and everybody flipped out. The next day, she announced that she would be managing credit spreads from here on out, and that's what she's doing. She's actively doing it.
So you think the ECB is buying treasuries?
I think the ECB is absolutely mucking with the long end of the yield curve in order to manage the rise in credit spreads because the German 10-year note and the German US 10 and 2-year spread have collapsed over the last 18 months. Actually, since the TPI was announced, really dramatic in the 2-year spread. Really not less dramatic in the 10-year spread, but the 10-year spread contraction started in 2021. And they've hit a nadir and they've bounced recently with the US banking turmoil and with the debt ceiling stuff. And now they're starting to roll over again. And they're starting to tighten because remember, German debt trades at a premium to US debt. So the tightening of that spread is the weakening of the German bond versus the US bond, right? So
they started at negative yields.
Yeah, because they started at negative yields, and so now
they had a lot further to go.
Yes,
to get interest rates up around inflation. So I think that's what's happening.
And note, this morning we're doing this morning when the Bank of England came out this morning and said emergency rate hike 50 basis points. They still have negative 4% in the Eurozone, like across the board. If the German 10-year is the benchmark
in real terms.
Yeah, in real terms. They're sitting at 2.5%. She's capped the German 10-year at 2.5%. She won't let it rise above 2.5%. And yet we're looking at Eurozone inflation at 7%. We're looking at German inflation at 7%. We're looking at UK inflation at 8%. And she's at negative yields. We're zero, or at best zero, maybe even positive. So relatively speaking, as bad as things are here, and I'm not arguing that with the data, like I agree with you, our data is terrible, but their data is apocalyptic at this situation, at this juncture. And with the U.S. getting past the yield past the debt ceiling. I don't know, maybe Blinken making nice with China. Like, we might actually be in a situation where all that worry finally lets loose, and we see a short up wave of investment in the United States on a safe haven play, which gives Powell more runway to do some tightening, allow things to kind of tick along in the background, as Danielle would put it, allow him to do QT, not raise interest rates from here, and let the market kind of run off for some of its duration risk for the next couple of months. What do you think?
So I think where I would say that, maybe we're looking too simplistically when we talk globally, because where you're really discussing problems is in Europe, and which of course is part of the rich world, and a lot of problems in the U.S. Even though you might say the U.S. is the again the cleanest dirty shirt. I know that's an overused term.
Fair.
But where things are a lot different is in the emerging world. So that's what I think is, again, underappreciated, and I think quite an opportunity, frankly. If you look at a country like Brazil, where their policy rate, their equivalent of their Fed funds rate is around 14%, and inflation's in the 4 to 5% zone. I mean, you're talking Paul Volcker type of real interest rates.
Right.
Mexico with something like 11% their policy rate, 5% their inflation rate, still 600 basis points roughly of real yield, and you see that pretty much throughout the emerging world.
Wow. Yeah.
So, and lower deficits. Basically, and if you looked at when they reacted to the inflation outbreak, they reacted in early 2021 for the most part, a year before the Fed. My point is that I think the money, this internet money is very fungible, and it goes where it's treated best. And I think it's, there's an epiphany that's occurring that perhaps, especially for yield, but I think even for equity performance, you don't want to be in the U.S. and you don't really want to be in the rest of the OECD, so-called developed world. These emerging markets look, really mouth-watering when you look at undervalued currencies. A lot of times commodity benefits, because like you, I believe that commodities are undergoing a correction within a bull market. I think we're in a super cycle for commodities over this decade, but you still get these nasty corrections just like you did in the 1970s. So that's another tale. So it's just like you got kind of a triple merit scenario for emerging market. Right now, I prefer debt, because I do think that the world is going to have some kind of a recession. I don't think it's going to be a broad everything down. I think there's going to be some economies that do. You mentioned Japan. I mean, Japan's OECD, but Japan is doing, actually growing faster than the United States. Now you could say it's because they've artificially suppressed interest rates, which I would agree with, and that could, at some point they're going to have to let that go. And I do believe the yen is going to have a huge move. I've been very bullish on the Japanese stock market, but I'm kind of rotating since it's moved so much, become so popular. I think the yen is a more interesting play, because that's one of the benefits right now. If you're a Japanese exporter, that yen is so cheap. Basically, labor costs, the yen is down so far. Labor costs are cheaper in Japan than they are in China. That's just shocking.
Right. These are all really great points, David. Thank you.
And I just don't see how that sustains. I think at some point the yen's going to have a monster rally. So again, opportunity emerging market. There's a lot of closed-end funds that are trading at deep discounts where you're getting double-digit yields, and so I'm definitely. People accuse me of being a perma bear, which I find ironic, even though I was so bullish back in the spring of 20. But I'm very, very, very worried about a lot of U.S. stocks, but I'm very bullish on emerging market debt.
No, I think that's a very great point. I think it's an underserved point. Even it's something I hadn't thought of at all, and I really appreciate it, because now you mentioned it, you'll think of it in those terms. It flashes back to something that kind of my early mentor in this stuff said to me, that one of the things you want to do when you're looking for a country to invest in is to look for falling real positive interest rates after they've gone through a peak. And then once they've hit a peak and they start to fall, that means that the worst of the crisis is over, and now you can start to get real. You can start to get real return. You can go into either the debt first, or you can buy the equities when they're really, really cheap, and just wait. And so I remember, that's just flashing back to a decade ago of learning that trick. So hearing those things about things like Brazil, and then I think Petrobras is paying some ridiculous yield of something like 30%. I did the chart read on it the other day, and some of
that's been one of our positions, and it's the dividends we've received were just unbelievable. Now they are under a lot of political pressure to reduce those dividends, which is ironic since the government's one of the biggest shareholders. But yeah, it's still a very high yield, and still a very cheap stock. I mean, since you brought that up, again, to get away from this this false image that I'm a perma bear, I think energy, because it has corrected, pretty hard. There's some just fantastic values there. The overall free cash flow yield, excess cash flow yield on the energy sector right now is about 14%. So there's just nothing else close to that. And
Agreed.
I believe that we are going to have another spike in oil prices that could happen even in the second half of this year. I think we're going back into triple digits. So these earnings estimates are going to start going back up. But frankly, until that happens, that's another headwind for corporate earnings. Frankly.
Okay, so you say that, and that's great because I agree with you. I've been saying for a while that I just think that we have commodity cost push inflation, that we have, and that the Fed has the wrong tools for this, right? The Fed has demand side tools. They affect credit-based assets prices with the cost of money. But when you have a commodity-based cost push inflation problem where you've got too much demand for commodities, not enough supply, and not enough investable capital, and certainly looking at oil, I've been saying for months now that, we talk about MAGA, the hell with MAGA, Moya, make oil investable again. The volatility on oil has been off the charts. David, it's insane. Like, I chart oil, I do very simple, technical analysis, and the way I do it, and I'm like, just divide the range, the weekly range, low to high, versus the price of oil, and it's going back to even when it was trading in the 70s 3 years ago. Then it was like $4, the range. Today it's $7. Or it was 4% then, it's 7.5% today. The volatility in oil on a weekly basis has doubled. And with the Biden administration utilizing the Strategic Petroleum Reserve as a political weapon, what we're having is volatility. I think it's all volatility washing of the small specs out of the oil markets in order to control the price of oil, to push it down as much as possible, to punish the Russians, right? That's clearly the policy. Oil is $72 Brent crude is $74 a barrel is to my mind is an abomination. This doesn't should be $90 a barrel, and it's very clear that they capped the price of oil about 4 months ago at 85 and then crushed it down and keep pushing the SPR out into the market and reweighting the Brent contract to 25% WTI in order to make that even more explicit. This is just and the oil traders are all going, no. And, it's trading at free on board at far higher than what the futures price is. It's a weird market in that respect. So,
yeah, it's very weird. It is very weird. But so, to your point, if you look long term, there's been a very tight correlation, and this just makes sense, between inventories and prices. When inventories are very high, prices are very low.
Sure.
That was certainly what happened in 2020 when the world shut down. Is all of a sudden you had a huge glut of oil, so the price crashed. The futures price went negative. I want to emphasize those futures, not cash. Cash went into the teens. But now it's radically different. We just ran this chart. We'll publish it tomorrow in our Haymaker, and it's going to show the oil inventories adjusted for the SPR going back 30 years. They're at 30-year lows. Well, guess what? Oil demand consumption is way up from 30 years ago. So when you look at it as a percentage of demand, it's even more shocking.
Right.
And yet oil prices are in the gutter.
Right.
And why is that? Well, you mentioned the SPR, and a lot of people don't look at the inventories adjusted for SPR, which I think is silly, and then you have the IEA, International Energy Agency, which has been unbelievably wrong. They've undercounted by over 1 billion barrels of oil over the years, and it's been going on for many, many years. They underestimate particularly emerging market demand, and they overestimate supply. And you've got a supply situation where, you maybe have seen this, that new oil discoveries are down 90% from where they were 10 years ago, or almost 10 years ago, 2014. That's down 90%. Now, what's been the lifesaver for the world, and for America in particular, has been the Permian Basin, basically shale oil. It's not the only one, but it's the main shale production basin in the United States. And the U.S., most people don't seem to understand that 90% of oil production increases over the last decade has come from the United States. And almost all that's come from shale, and the majority of that's come from the Permian Basin. Well, these other shale basins are actually seeing production decline. The Permian is still growing, but at a very slow rate. And they're now starting to see drastically falling productivity. I think very soon you're going to see the Permian level out and even start to contract.
Yep.
And then with all the CapEx starvation that you were kind of touching on that's gone on over the last decade, which is true pretty much throughout the commodity complex, but really true with oil, the potential for just a catastrophic price spike is you know, the Saudi oil minister said that he believes that given the way things have trended in terms of, you know, underinvestment in new oil, that you're going to see a 30% decline in production by the end of the decade.
Right.
So that would mean going from basically 100 million barrels a day to 70 million. You would have a deficit like we've never seen before, even in the 1970s. I don't think it's going to happen to that degree, but I think he's directionally correct.
Right.
So what's that going to mean if oil prices spike and, you know, let's say commodity, but energy is just so pervasive that it's the most important commodity because it is so pervasive. And what happens to what does the Fed do if we get another energy price spike? And by the way, look what happened to natural gas prices in Europe last week. They doubled almost overnight, even though storage levels are pretty high. I believe there's tremendous complacency in Europe that their energy crisis is behind them. They got really lucky last year with the weather and with China being locked down. But just, I guess, on that point.
And the euro bottomed in October, and they refilled with a rising euro against a falling oil price. The Europeans are paying 35% less on a currency adjusted basis, or 40% less on a currency adjusted basis for energy today than they did last fall. When the euro starts to fall over, which it's going to in this scenario, because look, you just told me everything I needed to hear, that and Powell's going to raise rates again, because inflation is going to come roaring right back the minute we have commodity cost push inflation. He has to get rid of oil. He has to get rid of the inflation from that, even though he knows this is not a credit driven inflation scenario. Like I look at this and I say, if he's got demand side tools and a supply side problem, why is he raising interest rates? The standard answer from the commentary is because he's a moron. No, he's not a moron. He's doing it for different reasons. The premise of your answer and of your question is wrong. He's attacking some other aspect and some other thing within the market that is the problem for him. And as I touched on earlier, I think it's trying to deleverage the shadow banking system to bring the dollar-based market, the global trade, out of the hyper-financialized world where the guys who make money on money get to decide what the price of commodities are, and the commodity producers get to decide what the price of commodities are. And then we'll have a very short window of time, and that's what this commodity super cycle is going to look like, where commodity producers will be the price makers as opposed to being the price takers. And that's why you're seeing OPEC, and that's why you're seeing the Saudis and the Russians make nice. That's why you're seeing the situation that we're seeing right now. And all the commodity producers, as Zoltan Pozar pointed out, it used to be, your commodity, or our money, your problem to commodity producers. It's now our commodities, your problem, right? And that's what I see. And I can't see the Fed going back to QE under that scenario. What I see is a complete credit collapse. And then I don't know what he does. If that's what he wants to do, great. But he's not going to have an option but to raise interest rates again. And in order to I think it's literally to bring the United States to onshore all of these dollars that are no longer, quote unquote, wanting to be demanded. And he has to. You're absolutely, David. When you said earlier that the world is selling treasuries and it's the biggest tail risk you're worried about in terms of the yield curve and rates and all of this stuff, you're absolutely correct. I agree with you 100%. So you have to think strategically. If you're the Federal Reserve, how do you raise the domestic demand for U.S. treasuries then? That's what I think he's trying to do. And I haven't even brought up SOFR versus LIBOR and the end of LIBOR, the beginning of SOFR, and all of that stuff. And I think it's a different world that we live in today, because the debt indexing in the United States is now domestically set in the repo markets, as opposed to the City of London deciding what our interest rates are going to be. Oh, by the way, that's a different story. But going back to this and all of the things you just talked about in terms of oil, I leave all that for you to consider. I don't want to actually discuss it, because I want to move on to, if oil is going to go through a catastrophic price rise, because I know this is near and dear to you. So I want to move on to something I want you to think about what I just said. We'll talk, we'll come back. We'll have another discussion.
I do want to come back to that.
Yeah, we'll come back to it 3 or 4 months from now. We'll discuss it again, right? But I want to talk about uranium, right? I want to shift the energy discussion away from the problems within the oil markets and start talking about nuclear energy. Because I know that's important to you, and it's important to me. And I know that my audience, if there's one sector of the stock market that I get asked for bespoke chart reads on companies on a weekly basis, when I do my weekly market reports and I do technical analysis reads for my patrons, invariably there's like, uranium stock. Like, guys, watch the uranium futures market, buy something because you're going to make money. Stop. But there may be better plays and other plays within it. But I want you to talk about what you see is happening in politically, structurally within the uranium market or the nuclear power market more broadly.
Well, I think that's what you just said. The P word is the critical part, the political attitude towards nuclear, which has done a 180. It's been very, apathetic or even anti-nuclear for so long. In the West anyway, very different, of course, in the developing world. So finally, belatedly, we're waking up in the West and realizing we are squandering the most energy dense form of power that you could have by keeping nuclear in the penalty box. But but to be fair, the problem is that I think the U.S. went the wrong direction about 50 years ago. Yeah, so I think 50 years ago, and there were political reasons, getting back to the P word again, why the U.S. went with light water reactors as opposed to particularly molten salt reactors, which are now having their second day in the sun. And I think that's where you're going to really see a lot of momentum building in the United States, is behind small modular reactors, which is kind of the general category. But beyond that is molten salt. And molten salt is from all the research I've done and listening to people that know far more about nuclear power than I do, it is the safest form, most efficient form for these small modular reactors. And so if you can get to a situation where there's virtually no nuclear waste, they're walk away safe. So if they lose cooling, they just, basically solidify. But there's not this, potential for what you had at Fukushima, which was an explosive situation where there was basically a core meltdown, created enough energy to actually separate the water molecule of H2O, which is very explosive, very dangerous. It takes a tremendous amount of energy to break that bond, that chemical bond, but it happened. Fortunately, it wasn't more catastrophic than it was, but it was, there was a guy that he's become one of my heroes. He died, I think, in 2006. His name was Alvin Weinberg, and he was one of the fathers of atomic energy in America. And he was an advocate for molten salt technology even in the 1960s. And they built a reactor that ran beautifully on that from like 1965 to 1971. And then he got sideways with Nixon and another powerful California Congressman, Chet Holofield. And they wanted light water reactors, and they wanted the jobs to go to Southern California, which was really heavily behind light water reactors. And anyway, so light water reactors won, but we lost because it's not. I mean, you can build safeguards, but the problem is we found is if you put enough safeguards on these things, that the plants become uneconomic.
Agreed.
So the Vogtle plants in Georgia are finally coming online, but I mean, decades after they started, and tens of billions of dollars over budget. It's just, we need a new system. But this idea that we can run the world on renewables with all their disadvantages, particularly how reliant we are on China for so many of the key materials, is fallacy, frankly. So to give the Biden administration credit, they are waking up to the potential of small modular reactors. So I think they're ready for, it should have been embraced 50 years ago, but I think they're going to get embraced now. I think that could lead to so if you had this, you could have a very beneficial combination of AI-driven productivity, which, that's a different story for jobs, but let's just focus on the productivity and say molten salt nuclear reactor technology. Those two coming into prime time at the same time could be very beneficial. We need some kind of growth miracle, because the problem we've got is our debt is growing much faster than the economy. So we're getting, in fact, we're in a debt trap. If you look at the total liabilities of the United States, including the unfunded entitlements on a present value basis, it's somewhere on 150 to 200 trillion. We can't service that debt, and which is why to the other point, I think the Fed doesn't want to do this, but at some point the Fed will have no choice unless they're going to let the system basically collapse. They're going to have to step in there as the buyer of last resort of treasuries. And maybe it won't be Jay Powell, maybe it'll be
the next guy,
somebody else that's head of the Fed.
Well, so a couple of things to unpack there. I do think that the return to QE is possible at some point, or at least a pivot back down into the 2 or 3% range. I think that's at some point the Fed's going to cut rates. It's just not going to be. I'll be honest with you. I think Powell is hoping for a political miracle that there is no second term Biden administration or second term vandal administration up top. That's what I think is going on right now. And that's why he keeps saying, high for longer or higher for longer, in the hope that in the second half of his term, he will have a political situation on Capitol Hill, which is sympathetic to what he's trying to do, as opposed to actively hostile. Whereas Janet Yellen is literally talking about, we have to de-dollarize the world now. And now I saw something this morning that now they wanted, I predicted they would do this, that the Democrats would go here to revoke the Fed's charter in order to get Powell to loosen rates. Now, when you hear stuff like that coming out of the political mouthpieces of people that to be, and I don't mince words, traitors to the United States, who work for foreign powers, and in my mind, they don't work for China. They work for the bureaucrats over in Davos and Brussels and all of that. That's what I think. Now, you can disagree with me. That's fine. But that's what I see. And I don't doubt that the Chinese are involved in some of this as well. Not going there. But when you see that, and you see what Powell's trying to do, that he's almost trying to, let's get through the 2024 election cycle. Let's get out of this. And at the same time, the Democrats are now trying to blame the Fed for everything, right? But when you start talking about thorium molten salt, which is something that I have also advocated and talked about in the past, know that. And part of the reason why the Biden administration has to start doing this is because the Chinese are have a 2 megawatt reactor that's up and running. And the Russians, Rosatom, has a 4 megawatt reactor up and running. They've been up and running in test mode for over a year now. And so they're working on the engineering problems within the old Oak Ridge molten salt system. And for those who don't know technically what this is about, correct me if I'm wrong, but from what my understanding is that it's the engineering of the cleaning of the waste within the fluid of the molten salt. The molten salt fluid has to be continually cleaned, and it's the filtration system that is the big engineering problem for a molten salt reactor, so that they don't lose efficacy and efficiency over time, and so that they run at a steady state. And that's, frankly, it's an engineering problem. As an old chemist, because I used to be a chemist in a former life. I understand that, right? It's just a chemical engineering problem. It's not now it's not a physics problem. It's it's not a limitation of physics. It's now just a materials problem at the end of the day. So, but I think that may be part of the reason why the Biden administration has finally had to give up on this grand, their opposition to nuclear power and to the small modular reactors.
Well, I would just say, more about nuclear power than I do. I'm more of an oil and gas guy. So this is stuff I need to spend about 10 years to really study to get a better handle on it. But right. I do believe people like Alvin Weinberg, who were brilliant in this field.
Yes. Weinberg
and they
was
said,
very
hey,
important.
this worked, and he proved that it worked. And you mentioned the Chinese. The Chinese just announced, maybe you're talking about another molten salt project that they did even before, but they just announced, it was either early this week or last week, they're doing one, I think somewhere, toward Mongolia, right, the Mongolian border, a molten salt reactor that they're actually, building. And I think it is thorium, as a matter of fact.
Yeah. And
thorium is an alternative fuel, and it's more plentiful and less expensive than uranium, but it really hasn't had a processing ecosystem, as I understand it. So it's been at a big disadvantage, just kind of like, light water. It got all that momentum behind it. The same thing happened with uranium. And so you got to create kind of a new system to support it. But, I think it can happen if it's really as good as a lot of people believe it is. And what is it? Kirk Sorensen? I think he's the guy that's been a big, strong advocate of thorium for quite a while. But anyway, what I would say to your listeners and to yourself is to go to the Micronuclear website. They've got a great little video that goes over how they've dealt with some of these energy engineering and chemistry problems that you've described.
Yep.
But they're convinced that they've broken the code. I'd say let's see one operating.
Yeah.
Before we really. But the fact that it could operate, 65 years ago, and basically flawlessly, that's pretty encouraging. But what they had, but there were a lot of pumps and valves involved with the original process, and those things wear out. So what they've tried to do is eliminate the pumps and valves. And so I'm fascinated, but I'm just kind of naturally skeptical until something's actually running in the field.
Agreed. I didn't hear the latest thing about the Chinese, so thank you. I'll look into that one. But I do know that both China and Russia started what are effectively test reactors. Like, these are research reactors, but they're at again, 2 and 4 megawatts, which are bigger than the one that ran at Oak Ridge back in the 60s. It was a very small reactor, and that one of the arguments against thorium molten salt for years, and we can go into this real quick just so you understand the difference, is that they don't scale to large size. But they're not supposed to scale to large size. We don't need them to run a city or 2 cities. We need them to run, neighborhoods or subdivisions or, parts of cities, and 2 or 3 small ones can run an entire city with a decentralized grid. So just so everybody understands, the light water reactors, the classic uranium reactors, are run on uranium-238 yellow cake that you get out of the Athabasca Basin or previously out of Australia or wherever. That's yellow cake, and you can buy it, and that's what's quoted in the spot uranium market, which is what we're and that, be honest with you, the reason we didn't pursue thorium was because we wanted to make nuclear weapons, and we needed the plutonium as the daughter product. The Department of Energy, in my mind, has always been a wholly owned subsidiary of the DoD. It's just been an outsourced, off-balance sheet project of the Department of Defense, and we've gotten some light water reactors as a benefit. Thorium molten salt works off of thorium-232, which bombarded with a neutron creates thorium-233, which breaks down to uranium-233, which is a neutron, which is a breeder reactor that creates 2 neutrons, which can keep the reaction going indefinitely, and is self-sustaining. Once you start the reaction, as long as you keep pumping fuel into it, you're giving it fuel, it'll self-sustain. If you pull the fuel out, well, then the reaction will stop. There is 100% use of all the fuel, or nearly 100% use of all the fuel. And thorium-232 isn't really even like terribly dangerous. Like yellow cake, it's not particularly dangerous. So there is, as you say, there is no real worry about breakdown or meltdown or anything along those lines, because they run at near room temperature or very low temperatures. And it's a very interesting design, and it's something that I've been screaming about for well before I became a public figure, saying we need backyard home generation. We need a decentralized power grid if we're going to survive this, and that's the one thing we're not allowed to have. And then you ask yourself the question why we're not allowed to have it, and that gets into a different political discussion that maybe is beyond the scope of this conversation. But go ahead.
Well, I told you you know a lot more about nuclear energy than I do, and you just demonstrated that. I would suggest you have my good friend from micronuclear, Richard McPherson, on, who's been in nuclear since 1964. He's 79 years old now, and I think you guys would have a great discussion because you guys talk the same language. But what you did say that even a layperson like I can understand is that, because it gets to one of my real peeves against what I call the great green energy transition, and that's the grid. I think that's the tremendous flaw of building these big solar and wind farms, which typically have to be quite a ways away from where the power is really needed. So then you got to have the transmission lines that you construct, generally greenfield transmission lines, and trying to do new transmission lines is unbelievably contentious.
Agreed.
So what I like about what you described is this idea, it's kind of like what they did with computers way back when, distributed computing. This is distributed energy.
Yes.
Have your energy sources, these smaller, that's why they call them small modular reactors. They don't call them large modular reactors, but have them located where you can run a military base, for example, or a relatively, like you say, maybe multiple to serve a small city, and then you don't have to rely on the grid. So I think there's a lot of momentum and awareness, momentum building and awareness arising that we need to have a different approach. That what we're doing right now isn't going to work, and it doesn't matter how many solar farms we build or how many wind farms we build. It just isn't going to do the job.
Oh, agreed. And I've been complaining for years. I'm like, if you look at companies like Plug Power and Ballard Power Systems and all the PEM fuel cell companies, like they've had 150 kilowatt modular PEM fuel cell systems that run on propane or natural gas. And they've had these for years. And they would, I don't understand. I've been saying this for years. Why, when we put in a new subdivision, on the outskirts of a city, why are we not running a natural gas line to what is effectively a phone drop? Like, it's like the building the size of a Bell phone drop for like co-located with the phone company drop for the area, or today it would be the DSLAM for digital, right next to each other, and then power the entire new development, and we don't have to go to the big coal-fired power plant or the oil-fired power plant, or or the rest of it. And then you ask yourself that question, and you have my experience, which is when you build your house, you're not allowed to get power until you pass the building inspection, and then you start to realize that this is all about control, and it's not about efficacy. And the question, I think, the entire theme of this conversation, we've talked across multiple markets today, is that these systems of control, of controlling of pricing, of oil, of bonds, of this, of currencies, and all of it, it's all breaking down. It's all reached its limit. I did a podcast with Caitlin Long. I don't know if you know who that is. And we talked about how she put it very eloquently. We've run out of room on the balance sheet for all of this inefficiency. There is no room on the balance sheet.
I agree with that.
Yeah, it's gone. So now what do? We have to start shrinking the balance sheet. We have to, and that's our own personal balance sheets, the national balance sheets, bank balance sheets, and all the rest of it, and get back to, where GDP to me is a terminally flawed statistic. It doesn't say anything. It just says we spent a lot of money. It doesn't say we spent the money wisely. It doesn't say we spent the money productively. It doesn't say anything. It says we spent a lot of money. Right? I think it's gross national spending. Right? I don't think it's that's the way I've always looked at it. And when you look at it in purchasing power parity terms, it starts to get a little closer to what it's actually worth. So, this worry about recession versus not recession, this, that, those are kind of nebulous terms to keep us from not being focused on what the real core issues are, as a lot of the things that you brought up today about the quality of credit, commercial real estate, and the cost of energy going forward, and how all those things are going to meet and explode, I think, which I agree with you on. So,
well, the problem is what you're describing. I said this earlier. I know we're running out of time here, but the deleveraging cycle, which is what we had in the 1930s. Mm-hmm. And it was allowed, I think you could say some people felt like it was way too Darwinian. Mm-hmm. It was Andrew Mellon, the Secretary of the Treasury under under Hoover, said just liquidate labor, liquidate capital. It was in the early 30s a massive deleveraging, but it was incredibly painful from a human standpoint.
Agreed.
Because you also had a tremendous speculative period in the 1920s, and a lot of borrowed money, and so can we pull that off? Can we pull off a deleveraging, given the amount of debt that's out there, and also given, the political forces which don't want to see that happen? I just think that there is so much political motivation to use inflation as the deleveraging tool.
Agreed.
And that's why I think ultimately, and again, we can argue about timing. I agree. I don't think it's going to be right away. I think the Fed is definitely going to continue to tighten here for a while longer, but at some point they're going to tighten too much, and stuff's going to start breaking. And I would argue some of it already is.
I agree.
And trillions of dollars have already been lost. You've had 3 of the biggest bank failures in the history of the country, and I don't think those are over. So, what will the Fed ultimately do? What will the U.S. government ultimately do? I think they will opt for inflation because it's the least painful end game. And if you're prepared for it, it'll be okay. But that's where I get back to long-term treasuries. Do you really want to be in long-term treasuries in that kind of a scenario? As my friend Simon Mikhailovich calls it,
not until we get a peak in rates. We have to have a peak.
Okay, so the problem, but this is again getting back to the developed market versus emerging markets, because this is a game plan I play. I'm 44 years in this business.
Right.
For most of that 44 years, whenever we get to the stage of the economic cycle, I would extend duration for client bond portfolios. I'm not doing that right now because I do think we're in a situation where a recession could actually be bad for long-term bonds, because you get in a situation. So, the old playbook isn't working. That's why I say that instead of thinking long treasuries, think about emerging market debt of, longer, they're not as long-term typically, but, you can lock in yield. So, because that's really what you want to do at this stage of the economic cycle. You want to lock in yield because rates are going to come down. Right. My argument is you don't want to do that in the U.S. because we have this balance sheet, as you said a moment ago, that is just so trashed that it's, you can get some trading rallies for sure.
Sure.
I'm not saying, but the kind of big sustained declines in interest rates that we saw through most of my career, I think those days are behind us, because I think the government's balance sheet is going to be and income statement is going to be so impaired during the next recession that it will just create this flood of issuance. Great. So there's always been somewhat of that tendency, right? I mean, you've got these kind of pro-cyclical deficits that happen, but this one is going to be just a mind blower.
I know. I agree. When I said a raise in rates, David, I meant when like after the recession and rates really rise. Like I think we're going to be looking at, 8, 9, 10% on the 10-year when this thing shakes itself out. In order to normalize the yield curve at 5.5%, we kind of have to get there. If you want the yield curve to normalize, we're going to have to get there. And at some point, that's what we're looking at. And it's going to be ugly. It's going to be disgusting. It's going to be really tragic. But unfortunately,
I just don't think they can go there. I don't think they can allow rates to go to 8, 9, 10%. So I think they will do some form of yield curve control to prevent that from happening.
Yep.
They've got to keep long-term interest rates, particularly below, the inflation rate, below the growth in nominal GDP to deleverage.
Mm-hmm.
And that's basically what we did, after World War II. It's what the British did after the Napoleonic Wars. It's what they did after, certainly they did it after World War II as well. So there's a pretty extensive playbook out there for that type of deleveraging, but it is inflationary.
Yep.
Even if they understate inflation, and I think that gives them even more political motivation to underreport inflation, which I have a feeling you believe they've been doing for a long time. I just guessed that.
No, fair enough. And so I think what it comes down to, as always, at the end of a show like this one, if you don't have gold, like you're doing it wrong. I'm not saying you want to have everything in gold, but you want to have bearer assets in a market like this. And
well, since you brought up
pick your bearer asset of choice, and mine happened to be gold and Bitcoin. But
well, I bet you brought up uranium versus uranium stocks, and I think gold versus gold stocks. So one of the problems I have with the uranium stocks is they look really expensive relative to uranium. If you look at gold, I think gold is going up, but I think these gold miners, particularly the junior gold miners, are the ones that can really go up, drastically. So it is odd, and it's just like with oil. Oil's cheap, but the oil stocks are even cheaper. And
right. So enjoy it.
There are definitely great plays for your listeners to great alternatives for your listeners to protect their wealth. But and this was a big message in my book, Bubble 3.0, is what's worked for the last 40 years is unlikely going to work for the next decade. Anyway.
No, absolutely not.
After that, who knows? But for the next 10 years, I think it's going to be pretty tough on a traditional stock bond portfolio.
Absolutely. David, this has been a lot of fun. I've really enjoyed getting to meet you and have a chat, and it's been good. And I think and if you wouldn't mind, I'd love to have you on again in a few months, and we'll do it again.
Absolutely.
Excellent. So
thanks
you have a wonderful day, sir, and we'll talk soon. Well, that'll about wrap it up for episode 147 of the Gold, Goats, and Guns podcast. I want to thank David Hay for his time and attention today, for showing up and putting up with a motor mouth like me. It's always a real treat to find someone else in the space who you haven't met before that has a similar worldview to you. It's always just it's not gratifying or edifying or anything. It's just good. It's just fun. I just enjoy finding new people. So I hope you enjoyed it. And as always, you can follow my work over at my blog at tomluongo.me. You can follow me on Twitter at TFL1728. And you can sign up at Patreon.com/Gold, Goats, and Guns, where you can sign up for the private blogs and private market reports or the monthly Gold, Goats, and Guns investment newsletter, where we take all of this stuff and we give out, bespoke advice and a portfolio strategy to try and help you make sense of all this and try and profit from it in some reasonable way. So we'll be back soon with another one. You guys be well. You take care. We'll talk soon. Keep your stick on the ice.